Thanks for joining this panel. This is the question that we all get the most. Should I invest in venture or should I invest in tokens? The answer I've given for 8 years is both. Getting exposure to the space is the most important thing, not overthinking which one versus the other, and it's best to have a portfolio of both of the assets. We've typically talked about the best way to think about blockchain is it's the final piece of the protocol puzzle that is the internet. The only difference is the other protocols that make up the internet, you couldn't buy a chunk of them. You couldn't buy a piece of TCP/IP, or you couldn't buy a piece of the other protocols. Here you can actually buy a piece of the protocols. And the importance is the protocols actually have the vast majority of the value of the blockchain space. So a portfolio that does not include tokens is certainly missing out on a lot of the value that we would see. So far, it's about 90% in tokens and about 10% in venture. Obviously, that can change somewhat, but over the 6 or 7 years that we've been producing this graph, it's changed very little. If you think of the difference between this and the internet, the protocols have zero value, and all the value is captured by a very small number of companies that control each of the data silos. It brings up it reminds me of an interesting question on investing in that blockchain space. I was once in a debate with one of the rarest animals on earth, an academic that's supposedly very intelligent, that's rabidly against Bitcoin or blockchain. It was a live debate on CNN 3 years ago. And he brought up, Bitcoin's just the pets.com of this era and blah, 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 and just kept going. Luckily, I had read his paper before on the way to the studio and was able to ask him a great question. I asked if he remembered who the majority investor in pets.com was. That stumped him. And it's a great parable for why to invest in a portfolio of assets here. The guy that was a majority investor in pets.com thought the internet would be very disruptive and you should invest in lots of different projects in the space. Apparently selling pet food on the internet didn't really work, but selling books worked great, and Jeff Bezos is doing fine. And so that's the mentality that I've always shared with investors, is you should try and get exposure to a wide variety of assets in the space. And that's essentially what we're going to talk about today, and why we're launching a fund that includes both of them. On the final slide that I'm going to talk about is just including all three of the different types of asset classes that we are active in. Venture equity is using these protocols to do something better, faster, and cheaper than you could do otherwise. Investing in similar projects that are structured as tokens, so it's a way for protocols to raise money, to pay for development, to pay for the staff it takes to create these things before they become completely independent. And then also, obviously, investing in these liquid tokens like Bitcoin and Ethereum, which dominate the market share, is a very good proxy for our industry. And with that, I want to hand it off to Paul and Joey to talk a bit about the industry.
Thanks. So I'm going to talk about some of the different asset properties. And if you look at venture versus early stage tokens versus liquid tokens, obviously venture equity is equity. Early stage tokens and liquid tokens are both token based. In terms of the return potential, I would say that the highest return potential so far has been around early stage tokens. And if you think about the stack in terms of underlying protocols, something like HTTP, and then the applications built on top, we've already seen that the protocols are accruing more value. And within the last 3 years, we've seen those types of protocols, smart contract protocols, scalability protocols come to market, and those will produce the highest returns and the highest market caps. And so, based off of past track record, that's where the highest returns will be versus venture equity and liquid tokens. I'd say both of those are about medium-high comparisons on the return potential side of things. In terms of relative risk, on the flip side, I would also say that on early stage tokens, you do have the highest risk not only do you have those projects being early stage companies like venture equity, the difference is not only do you have to navigate being an early stage company, but you also have to deal with regulations, a community, a lot of volatility, et cetera. And so, I'd say that would be the highest risk. And then of course, early stage companies with venture equity, and then liquid tokens would be next. They've already gone out there, launched a token, gone through a lot of the building, development, community, and regulatory side of things. In terms of liquidity profile, liquid tokens are the highest of liquidity. That's why, with our liquid token fund, it's quarterly liquidity. We can get out of these fairly quickly through exchanges. That's also a factor in what determines what is eligible for us to invest on the liquid token side, having enough liquidity. And then both venture equity and early stage tokens are a bit more illiquid, with early stage tokens being more liquid because they are like venture, but their path and their time to liquidity is usually around the 2 to 3 year horizon. Accessibility, venture equity and early stage tokens are both highly inaccessible for investors. You really do have to have the right brand, the right value add, and the right network to get into these deals versus liquid tokens you can kind of go out there and buy. And then I talked a little about the holding periods, but the holding periods for venture equity is much longer than early stage tokens, which is a bit over a year, and liquid tokens are anywhere from hours to years, hopefully soon, maybe even minutes. So what is the case for having both tokens and equity? So number one, that's actually the trend in the industry, to invest early on and get both tokens and equity. I think the biggest thing is you're investing into these early stage companies, and sometimes you just don't know which direction they're going to go in. Equity may make sense at first, and then they might decide that they need to issue a token to decentralize the network or to empower their users to have more control for governance, or potentially other sorts of decisions that need to be made using a token. So it really does give both the entrepreneurs flexibility and also the investors flexibility to be open to whatever direction these entrepreneurs want to go in. And then also I think it provides a bit of diversification too, especially if you talk about having both separate token projects and equity positions within an entire portfolio. Especially during a bull market like this, it's great to have tokens. But during the potential bear market, then having equity positions makes a lot of sense, because those companies are not having volatile valuations. They're building very strong IP. There could be potential for mergers and acquisitions, things like that. And so I think that really just kind of helps think about a basket of different things for basically just kind of balance of volatility and returns. Return potential, I think both offer high return potential. With tokens, they can offer higher return potential, but with equity, it depends. If you're getting in seed stage companies and then you're exiting when it's a multi-billion-dollar company, those returns can still be very tremendous. In terms of venture equity, why invest into venture equity? Well, the types of companies that these are basically the picks and shovels of the ecosystem. They're providing infrastructure for the space, starting off with centralized finance, which are basically exchanges, wallets, and payment companies, to even doing things like services and different applications for the space. And then, of course, now we're getting into more infrastructure for decentralized finance, which we'll get into a little bit later on use cases. The risk and return profile, I'd say that there definitely is tremendous upside, especially if you're getting in early. And the downside, I think, is also a bit more protected, because these companies aren't building open source projects. They're actually building IP that they are keeping to themselves. The team has a lot of value, and especially in a nascent space like blockchain, where there's just a huge demand for talent, we can actually see a lot of acquisitions or acqui-hires that happen for companies that just don't get product market fit. And compared to other VC funds, our loss ratio is much lower than, other traditional VC funds because of this. And we actually spend a lot of our time helping our companies figure out the best sort of way to exit, whether it is through an acquisition or whether it's something much larger like an IPO or a much larger acquisition. And then in terms of investing, I'd say it's going to be fairly similar to early stage tokens, but we're really looking at strong teams, and we're looking at deep technologies and deep technical sort of expertise, because these companies are building tech that isn't going to be open source. So this is going to be very proprietary. We want to make sure we understand how that is going to move going forward, and if that's going to be a competitive edge for them. And of course, we like to target huge problems in very large markets. In terms of the areas of focus and what we've done so far, so I'd say a lot of this is around infrastructure, starting off with developer infrastructure. So we led the Series A in a company called Alchemy, and they're providing sort of the Amazon AWS for developers in the cryptocurrency ecosystem, starting off on Ethereum. They make it very easy for you to run a node on the Ethereum blockchain and be able to then, query the blockchain, and they'll come up with other different tools to make it a lot easier for you to develop applications and maintain your applications, optimize your applications, make sure that it doesn't go down, things like that. And so you can imagine that they can really be a horizontal infrastructure, not only for Ethereum, but whatever blockchain comes about, because we do think that not only is this going to be a multi-token world, but this is going to be a multi-blockchain world. And these guys are going to be, the developer infrastructure for all of that. In terms of enterprise infrastructure, one company that we invested into is called Off-Chain Labs. We led the seed round. Very strong team. The CEO used to be, deputy CTO under the Obama administration, but they are very, very deep on technology around scalability. So they are looking to help Ethereum scale. And, that is, a huge problem right now when gas prices for average transactions are between $50 to $100. And there's potential for Off-Chain Labs to expand over to enterprise use cases of blockchain, similar to JP Morgan's Quorum. And then on the finance side, Matt talked, Matt Gorham of our team talked a little bit about staking, but imagine now all of these networks moving to proof of stake, and you can actually help provide security and governance for these proof of stake networks. And for that, you actually get yield, and these yields can come in the form of about 10% on average for our protocols. And so Stake provides a API, or basically a Stripe for staking or for yield, and makes it very easy for any investor to stake their assets. And they're doing it for a lot of the large infrastructure projects in the space, for a lot of the funds. We do a lot of our staking with Staked, and we think that they could really expand on the product line. On the consumer side of things, Bakkt is a futures contract and a digital wallet that is, it was started by ICE, the parent company of New York Stock Exchange. So it's really the first milestone for hopefully bringing institutional investors into this space. They just got some news recently that they helped Paul Tudor Jones get into Bitcoin through custody, and now they're launching a digital wallet to help people store all of their digital assets, whether they are cryptocurrencies or whether they are things like loyalty points, airline miles, etc. And then on the exchange side, which we've been very, very active in, we feel like having a fiat on-ramp or a Coinbase for certain geographies that make sense for cryptocurrencies, whether it's because of their monetary policy, capital controls, propensity for virtual currencies or goods. We think that having local players building that infrastructure and building the trust is really important and will generate a lot of value, as you can see from the Coinbase and their IPO. So we are invested into Bitso, actually one of the largest investors in Bitso, which is the Coinbase for Latin America. In addition to providing easy on-ramps, they actually do provide basically 7% of all the remittances from US to Mexico go through their rails and end up in Mexico through their partnerships with banks and other cash on-ramps through either the Western Unions or other sorts of 7-Elevens, OXXO in Latin America. So they're really dominating the entire geography. And then the last company that I'll talk about is on the payment side, called CoinMe. Joey is also on the board of CoinMe, but they basically provide the infrastructure to help get cash into a digital wallet and be able to send it across borders to another infrastructure provider that has a cash off-ramp. So imagine partnering up with Coinstar or those types of companies to basically help onboard cash to crypto and be able to use it for remittances and get it back into cash. And they provide the sort of API to make that all happen. They have a consumer wallet that makes it very easy to send money across borders too, and they're growing quite rapidly. So we led the Series A of that company. In terms of some other venture case studies, so we talked a little bit about these two companies, but we were in the seed and Series A of Audius. Audius is a decentralized, SoundCloud competitor, but they could really be expanding over to other types of content, such as NFTs. I've known the team since 2015. CEO used to be at Kleiner Perkins as an investor and also as an entrepreneur. They've grown really, really well. I think it's one of the most used decentralized applications out there, having almost 4 million monthly active users. And they launched a token. Governance is already starting to run through. And the beauty of being built on the blockchain is that you're enabling artists to actually get full value of what they're creating because they can distribute their content directly to the users instead of going through the middlemen. And the token itself helps to incentivize usage of the platform. By having content on the platform too, it's also provides censorship resistance so that people can other intermediaries can go in there and remove that content. So it really allows for the longer tail of content to be pushed out there. And we invested in both of those funds, and the returns have been quite astonishing. I mean, 95 times capital for the seed round investment and 173 times capital for the Series A investment. So that's done pretty well so far. And another company that I've talked about a little bit beforehand is 1inch. 1inch is basically a decentralized prime brokerage. So right now, if you want to go out there and you trade on Uniswap, you can trade certain assets and on certain prices, but there may be better liquidity, better pricing in the other 30 or 40 other exchanges out there. And so by going through 1inch, it could be the only place that you need to go to actually find the best price for whatever asset you're looking to trade. And even if you are looking to trade, and all of the liquidity is just on 1inch, by trading on Uniswap, by trading on 1inch, they've actually, with their algorithms, made it even more cost effective through some of the things that they've done with gas optimization, where you can still even save more money on trading on 1inch, even though all of the liquidity is just on one platform. And so we led the Series A, and the investment is currently up 66 times capital. They are leading the market right now in terms of the use case. And we really think that in decentralized finance, where there is going to be a lot more fragmentation because it's harder to build a moat and liquidity is going to be fragmented, aggregators are going to really get a lot, or if not most of the value. In terms of the results of our 3 venture funds, Venture Fund 1 was focused on just on-ramping, buying, storing, securing cryptocurrencies. Venture Fund 2 is around some initial use case around payments and micro payments and some other developer tools, things like that. And then Venture Fund 3 has been really targeted around the institutionalization of the space. And if you look at our returns, Venture Fund 1 was in some of the early winners, pretty high, 7 times capital TVPI. Venture Fund 2, still very solid at 5x. And then Venture Fund 3 has already been 7x because some of the early returns during this bull market around token investments. We've had 18 companies realize capital so far, and the gross TVPI of those exited positions are around 7.2x. In terms of early stage tokens, why do you invest into early stage tokens? Because there are protocols that really can enable use cases that can't be done before, especially if you need to have decentralization to enable those use cases. So Augur is a great example of that. And you need governance within your ecosystem, or it's providing sort of underlying infrastructure for applications to be built on top, such as scalability protocols. And they just provide really high outsized returns. But as I mentioned before, there's a bit more risk around the stage and around regulations. So how do you invest into these? It really does help to have really good understanding of technology and how it fits in with the broader ecosystem. But everything else is really just around evaluating early stage teams and making sure that there is actual usage for the token and that the value will accrue to the token. Two use cases that I'll talk about, Polkadot and Dodo. So Polkadot is in that early vintage of scalability protocols. And basically, they started off in 2017, and the founder of Polkadot is the CTO of Ethereum. And so we've known Gavin Wood for quite some time. And when he was thinking about creating a more scalable Ethereum that can enable interoperability, and we felt like that was a very, very strong use case and a potential huge competitor for Ethereum. So we ended up being one of the largest investors in Polkadot. And that investment has done very well for us. I mean, in a few years, it's turned into a 126x return. And we've really been helpful in helping them grow their ecosystem. Now they have about 400 developers building on top of Polkadot, and are second behind Ethereum in terms of community, and are about to launch their parachains and having their applications that are being built on top come to market. So for us, it's been just really a lot of community building for some of these early stage smart contract protocols. And then the other use case that I'll talk about is Dodo. Dodo is an on-chain liquidity provider similar to Uniswap, except it uses a PMM, or proactive market maker algorithm, which should provide better fees and more minimized price slippage. And what's interesting about this deal is, similar to how exchanges are a bit fragmented based off of geography, we believe that Dodo has one of the strongest teams in China and Asia, and has been able to really build up a huge community over there. So this really just shows how global we can be to find local partners to get us deals, and where we can come in and provide the global expertise and industry knowledge. And so what we've been able to do is really help them think about cryptocurrency and help them think about scalability. And now they are thinking about ways to expand their product to an aggregator and also an NFT minting platform. So we led the Series A, and the multiple is now at about 85x. In terms of the results of the early stage token fund, so we have about 1.6 billion of assets under management. We returned 1,208 percent return. And you can see some of the other positions that we have that have generated pretty outstanding returns for the early stage token fund. Flexive being sort of a cryptocurrency network, Injective being a decentralized derivatives exchange, Filecoin being decentralized file storage, and then Ampleforth, which is a new type of money. I'm going to switch it over to Joey to talk more about the liquid side of things.
Awesome. Thanks, Paul. I'm going to walk through the liquid strategies. So if you look at liquid tokens, the reason to invest in liquid ones is they often have longer track records and more established communities around them. And so they've been around longer. The teams have, a longer track record of shipping quality software. You can actually see their growth. One thing that's very different this cycle than in 2017 is that projects actually have fundamentals beneath them. So you can look at things like how much trading volume is a decentralized exchange doing. You can look at how much is being borrowed and lent on a decentralized lending protocol. Many of these DeFi apps actually have revenue or cash flows underneath as well. And so you can look at how the cash flows are growing. You can even do things like calculate, an earnings multiple. Some projects are paying their cash flows, so you can calculate an implied earnings multiple if they don't have that. But the point is, the space has matured a lot since 2017. And there's actually a lot of analysis that you can do at this point. And so I think when looking at, digital assets in general, all of it is fairly high risk, high reward. But I think some of the larger liquid tokens, it probably have less risk on a relative basis to some of the more early stage ones. And so if you look at how to evaluate liquid tokens, there's a bunch of different things that we look at. So for one, we're looking to make sure that, a token has sufficient liquidity. And so what that means is basically, are we able to trade the token? Is it liquid enough for us to be able to get in and out of it fairly quickly? Back in 2017, there were really only 30 or 40 things that you could trade. These days, there's probably, 100, 150, something like that. At this point, I often actually go to the second page of CoinMarketCap. You used to never go there, but now there's actually a lot of interesting assets there. Some of the smaller stuff, it still has enough volume to actually be able to trade it. We're looking for strong teams, the sort of same thing that you would look at investing in any company or early stage venture. You want a team that's being able to build a really strong community, who can also basically ship software pretty quickly. The speed at which projects iterate on software is really important and key here. Some of the best performing assets from a price standpoint also tend to be some of the ones that have the fastest shipping cadence. They ship the most software. We'll also look at things like market size, how large is the potential market. We'll compare assets on a relative basis. So you can look at things like Aave and Compound are two good examples because they're both lending protocols. When we put those positions in the fund, we actually did a discounted cash flow of them both. We initially decided that Aave was cheaper, and so we overweighted it for that reason, and that was a great trade. Recently, we put a bit more into Compound because we thought it was undervalued, and that's been a good trade as well. So you can start to do these kind of relative value trades that just didn't really exist for the most part 2 or 3 years ago. And then, so if you look at the things from a portfolio construction standpoint, I think there's 2 or 3 different ways to look at that. One is a traditional market cap side of things. And I'd say for our fund, we kind of split it up. I'd say the fund is invested maybe 30 or so percent, 30, 40% in things in the top 10. And then, 60 to 70% in things below the top 10. And it tends to be fairly concentrated in the top few assets, and then things that are ranked, 20 or so to 100 on CoinMarketCap. There's a lot of stuff that's froth kind of in the middle ground that we think is not the best risk reward. The other way to look at it, though, is looking at what the underlying projects actually do. And so, again, 3 years ago, almost everything was just a layer one. MakerDAO just launched on Ethereum at the end of the last bull cycle in late 2017. Uniswap wasn't really even out yet. Now you have a ton of these lending protocols, a ton of decentralized exchanges. You have a lot of other stuff that I kind of put into the bucket of miscellaneous DeFi assets that doesn't quite fit into any one category. And we sort of split it up about 40% layer ones, 25% lending, another quarter or so decentralized exchanges, and about 10% is in sort of assorted DeFi assets. I think the other thing to look at from a portfolio construction standpoint is, when do you put a position in or out of the fund? And I think it's sort of the inverse of when you would put a position in. So if those reasons that I outlined earlier are no longer true for a position, we'll exit the position pretty quickly and put it into whatever we think is most undervalued instead. We typically hold about 15 or so positions. The other type of trading that we'll do is more kind of macro, taking risk on or off. And so we do that when we think the market's overvalued. There's a lot of different things that we look at, everything from sentiment indicators to technical indicators to on-chain data, looking at, how much unrealized gains is the average holder of Bitcoin sitting on, things like that, how much, leverage is in the system, things like that give you an idea for how overheated the market is or isn't. And when those things kind of align and tell you the same thing, it tends to be a pretty high expected value trade, to either take risk off or in the inverse, put more risk back on. And so we've been doing that, through the course of this year. We did that in January and February, and I anticipate we'll continue doing that, throughout the rest of this cycle. And so if you look at performance, so Pantera has been investing in the liquid token market since 2013, when the Pantera Bitcoin Fund was launched. And back then there really was only Bitcoin. There was Litecoin, I think, launched in April or so 2013, but there really wasn't much else. That fund currently has about $1 billion under management and just under 82,000% life to date return. The liquid token fund, which is our diversified portfolio strategy, kind of across the whole spectrum of liquid tokens, launched in December 2017. It manages about just under $500 million under management, 0.4 billion, and its life to date return is 395%. And so with that, I'm going to pass it back to Dan, and he's going to give an overview of the Pantera blockchain fund.
Thanks, Joey. So in order to save the asset allocation considerations from our institutional investors, we're putting it all together in one package. We'll be able to do those types of relative value trades that Joey talked about. Sometimes tokens are cheaper than venture, sometimes venture is cheaper than tokens. We'll be able to get into the most attractive section of the markets at the time. Often Bitcoin itself, there's a ratio called the Bitcoin dominance, which is a good barometer of kind of hype one way or the other. It goes up to 70 at its peak the last 2 times in the cycle, and then it's gone down as low as 32. So we'll be able to weight the things we think are cheaper than the rest of the industry. It'll be typically the majority in early stage venture, early stage tokens, and we will just use the liquid tokens to get exposure early on, and then when we think it's cheaper than venture itself. The next slide has the visual representation again, just a reminder that it's the same assets. We're doing exactly what we're doing in our current 4 funds, just for those investors that want to have it all in one entity, one fee structure, one decision. And with that, I wanted to wrap up